Next up, we've got RTA, RTLC. Russ has some news for us on this that I know he wants to share.
Well, on page 22 through 23 of, I'm sorry, 24 of your package, you'll find a letter that I mailed out to the members of the RTA board in my capacity as president of the Racetrack Authority, with copies to the members of this board as well as to the governor. And I had hoped that the conversation had kind of been drawn to a close in the last calendar year, but with the introduction of SB1, the conversation about the potential sale of the fairgrounds continues. That being the case, I asked Rita Walls to go out, talk to bond counsel, and find out just exactly what that would mean in the event there was a sale of a property. I'm not going to dwell down completely on this letter, but I do want to point out a couple of points. One is, in the event that the property goes from being a nonprofit to a profit organization, and with a lease to the individual racetrack owners, that would be private individuals, which change categories, so that basically becomes any bonds would be taxable bonds, so we've got a concern about the bonds that we have issued. Basically, what would have to happen with the transition of the property is those bonds would have to be retracted into fees, and Mike, please correct me if I get off track here on the technical terms, to make sure that the bondholders would not be subject to taxes downstream, and that would be retroactive. That has the potential to be retroactive, which would leave the fairgrounds at huge liability. That being the case, bond counsel has recommended a number of different things, some of which says this has to be an arm's length transaction, and one of the most important of these is that the deal be done at fair market value terms. As everyone knows, the state did go out and do an appraisal of the property. The Department of General Services went out and had that, Department of General Services went out, had that appraisal done without consulting this board as to how that appraisal should be constructed. We did have some inputs into, we did talk to the folks that came down and did the appraisal, but we did not have any input into the way fair market value was defined, nor did we have any input into the assumptions that were made in the appraisal of the property. What I find a little bit concerning was the way that the company that was hired, the way fair market value was defined, and basically it was defined, let me get down here, and I take this directly out of Integra Realty's defined fair market value as a measure of compensation for property taken. This definition was derived from Chapter 1275, Title 7, Part 3 of the California Code, entitled Eminent Domain Law, which is what the state does when it needs a piece of property to put a road through or something else through. Obviously, the state would like to get the property at a value less than what might be considered fair market value. And when this is normally done, you usually end up in litigation, and whoever owns the property gets the property appraised, and the state has its own appraisal, and you end up in court. You have a conversation about what the fair market value really is. Further, when it comes down to the assumptions, one of the assumptions that stands out, and it says these special assumptions were made at the request of our client, i.e. the state. We have assumed a sale to a private party that will be subject to real estate taxes, which means one is that it's a private party will be subject to real estate taxes. The other part is that also they will be subject to taxes on whatever income is earned, which kind of takes us back to the original conversation I had last month about what the debt coverage, what the debt that this property can sustain. We have about $8 million in free cash flow right now. We're using about $2 million of that a year to pay down debt. Under the current construct of the way folks have been talking about doing the purchase of the property, the total amount of debt would about double, and that would be taxable, which means you've got to pay a higher coupon. So the total going out in taxable dollars would probably be up in the $6 to $7 billion range, which doesn't leave a whole lot of money to go back into the property. So something to be considered. The other thing that Integrity Resources said is they specifically did not use a sales comparison approach in their appraisal methodology, as there is not an active fair for similar properties, and sales data is not available for analysis. I would say to the contrary, with Orange County currently going through this process, the price tag on that property is $100 million. The price tag that's been offered for this property is $120 million, and Orange County is about 2/5 the size, does not have an operating racetrack, much less the #2 track in the country, does not have a covered arena, and on and on and on when you go into the conversation about capital improvements. What we have done is we have gone out, we have hired CB Richard Ellis. I authorized staff to go out and get a preliminary valuation on the property. That preliminary valuation came back at $250 million. Based on the preliminary valuation, I have authorized staff to go ahead and proceed with a full appraisal of the property, because I think the initial conversation we had with CB Richard Ellis is that given chances to dive further into the books, that the numbers will probably come in higher than $250 million. So if we're going to have a conversation about fair market value, which we must, based upon bond counsel's guidance so that we don't end up in litigation with the bondholders, then I think we really need to have a conversation about what is fair market value and how is it defined. And I would offer that the first try that the state made on defining fair market value was way undershooting the mark. And we can talk about a number of reasons as why they got there. I don't want to speculate here, but I let the letter stand for itself, and we will see what kind of response we get back from the rest of the RTA court. But that's all I got.
Russ, the only thing I wanted to mention is in your talk just now, you mentioned that the debt service was $2 million. I think you meant interest.
Interest payment, just interest payment on the debt. Right. That's not principal and interest, that's interest only.
Correct.
And then the other part, when I say free cash flow, these numbers are taken before, basically it's called EBITDA, before depreciation and interest and amortization, which we don't have a great deal of. So we depreciate about $7 million a year.
Yes.
So basically, the additional cash flow dollars normally go back into capital improvement. So if you depreciate a property without putting the dollars back against the depreciation, eventually you end up running your plant to the ground.
On behalf of the board, Russ, I want to express district appreciation for the time and effort that you put in on behalf of the RTA. Obviously, you're wearing two hats, but you really stepped up to defend the value of the property and the asset, and I really appreciate the work you've done on this. Like all of us, we're very confused why we're still having this conversation. CB Richard Ellis, I know personally, is the most prestigious appraisal firm in the country, and for them to come up with a number in excess of $250 million in consideration of our property that is being sold at $120 million with very soft terms, which in this business means the price isn't 120, maybe it's 100, maybe it's 90. To me, seems crazy that we're having to still discuss why this is even an ongoing conversation in the public eye. But fortunately for all of us that care about this property and its value to the 3 million people that live here, you're doing something about it, and I appreciate it.
And I too would like to thank you, Russ. This is, I mean, really, this is earth-shattering to me. You know, another arrow in our quiver for those of us who are taking on this asinine proposal that Del Mar's advanced. I've been spending a lot of time, in fact, when I was as recently as yesterday, and on the phone and in meetings, and there's just absolutely becoming a groundswell of opposition up there across the board in a very bipartisan way. I mean, many of Senator Keogh's Democratic colleagues are, you know, both publicly and privately expressing skepticism, to put it mildly, and many of them are going to be taking active stances opposing this. But this is huge, and I would like to make sure I understand this, and for the media and the audience, hopefully they can make sure to report it correctly. But the appraiser that the state hired utilized the procedures for eminent domain to
The language that I put in there, I took directly out of the state's appraisers' language from their document.
So I'm not an expert, so why would the state use eminent domain on ostensibly a state-owned property already?
Why would you use the value for taking property that you already own?
Right.
I have no idea.
Why would a buyer use seller methodology?
Right. So I
And
remember...
that goes into, I mean, you can have further conversations about competence, or you can have conversations about motivation, or you can have conversations about both.
Yeah.
But, you know, I would prefer not to speculate. The bottom line is, I think they undershot the ball by at least half.
Well, we don't need to speculate. We've had at least 3 different council members come to our board and give completely different answers each time they come. So we can certainly discuss a number of those issues. But I read the Integra appraisal, and on page 2 or 3, it said right in there, we were instructed to not place the highest and best value on this property. Is that true?
I'd have to go back through and check through the language. I've got the assumptions, and I pulled language that was compelling to me out of the document. And then I've got the list of assumptions right here in front of me. You know, some of which are good assumptions, that the property is at its highest and best use as a fairgrounds and a racetrack. And I would agree with that. The fact that you're gonna put yourself in a box and say that you're gonna sell it to a for-profit organization, you know, I would argue with that. If you want to take a look at the bigger picture of horse racing in this state, I would offer that horse racing probably ought to be on public lands. Because when you take a look at the private tracks, all of the private tracks are struggling. And so when you take a look at a billion-dollar industry on the state, the one place where that industry is thriving and the track is thriving is at Del Mar. So you can make an argument that, you know, at the end of the day, you may end up with the health of racing in California depending on racing being run on public property.
You know, another point that those from the Del Mar Council have said publicly, the explanation why the value seemed so low, was that they had to assume that the fair and the horse and the race meet continued. But the CBRE's initial preliminary evaluation, do they make that assumption as well?
Oh yeah, that the activities continue on the property? No.
In the same
Yes.
sport.
Right. So you got a swing figure of 130 million at least, still assuming that existing operations continue.
Yes.
And yet Del Mar's admitted publicly that they plan to eliminate most of the year-round events. So how will that then impact the revenue stream? Any ideas?
Well, you have less activity on the property, and it's going to reduce the revenue stream.
I think it's just incredible. I mean, it's a huge development that all of our friends in Sacramento are going to want to hear about.
The most important thing they should take away from this is the argument about fair value is an argument. And it usually results in litigation and eminent domain cases and in non-negotiated. The problem is if they're wrong, and this is deemed not to be for fair market value or an arm's length transaction which was not anticipated, the taxable nature of the bonds that we've been living under are retroactive at least until this issuance, which was 2005, and possibly since they were used to pay off prior tax-free bonds, you might look back there. The consequence is those purchasers now have a tax liability for the interest they received in what were ostensibly tax-free bonds. So they have a liability, and guess what? That means the issuers of the bonds have a liability because they sold them as tax-free bonds. So if they're taxable, you've got potential litigation to sue the issuer, the state, RTA, the leasing corporation, and I think we pledged, I don't think we were a signatory to the bonds, but all of those organizations have a potential litigation liability for the cost of the tax and the loss of future revenues on a tax-free basis. I mean, you got a huge litigation risk if you proceed without defining this. And that, if I were a state official, I'd be looking very seriously at that. And I think we as a board have to look at that.
You know, it's curious, Mike, actually you, Russ, and Adam are all making excellent points. The comments that I've made repeatedly, both here and in other groups I've spoken in front of, like you, Adam, legislative groups throughout the county, is when you have a privately negotiated transaction, by definition, you haven't arrived at the market price because the market hasn't been allowed to participate. They often say the most pure market in the world is the stock market because buyers and sellers are meeting on a minute-by-minute basis to determine bid and offer to come up with a market price. When you negotiate a sale privately, it's the buyer and the seller at that moment in time have decided what they want to pay and what they want to sell for, and that may or may not be fair market value. And Russ, what you've discovered already on a preliminary basis is the price is off by at least double, maybe more. My understanding of the CBRE report that's in progress is they're now going to consider the economics of all the events here, which were not included in the previous report, and their number may approach 300 million. So there is a wild disparity between what the market really is and what the pending legislation would authorize, which is a sale at maybe a third of market price. Now, the other thing that you consider is terms. This is not a cash sale that's being considered. It's a highly leveraged, in fact, completely leveraged transaction, borrowing from the state, borrowing from new bondholders, and selling the lease 50 years to 55 years in advance, which really means the price isn't $120 on very soft terms. It's like, I'll buy your house for $1 million, give me 300 years to pay. What did I really pay for your house? Something significantly less than $1 million. In this case, $120 million being authorized by SB1 on terms that are astoundingly soft might give a net present value of 70 or 80 million, when value is really 4 or 5 times that amount of money. So I think it's really important that the public understand that the reason why this board is so protective against this type of transaction, it's our job as trustees of the public interest, in this case 3 million people that live in this county. We want to protect this asset for the 3 million people and not allow those people to be ripped off. So that's my point.
One last comment just occurred to me. It's just incredibly ironic to me that, what the first excuse that Del Mar gave was that Schwarzenegger was going to sell this property to a private developer. And that's why they were coming in to rescue the day. And yet now he's gone, and they're the only ones advocating a sale, and they're in fact selling it to a private developer. For now, what we find is less than half its actual value, which they've now opened up a Pandora's box, and I don't think they're going to realize the full consequences of that for quite some time.
Barry, I think to your point, a sale of a property clearly would not be in the best interest of the state. This property generates money not only for itself and the people of San Diego County, but also for the state through the racetrack betting. It's not in the best interest of the people of the county. And I don't think it's in the best interest of horse racing. So kind of across the board, I don't think it's in anyone's best interest to sell this property.
Just one, how long have these bonds been in place now?
Since 2005.
It's probably worth saying, we talked about it here before together, but it needs to be reiterated that Russ was very involved with the success of these bonds in the first place. And that was years of work. And I don't think anybody understands the obligations that we entered into better than you do. And so we're fortunate to have you here. We're fortunate that you take those obligations seriously, that you investigated thoroughly, that nothing that we can do as a board or at the RTA we will ever do that would in any way undermine those obligations. So thank you for your work and for the final effort here on this.
Russ, there hasn't been any response from Sacramento State, has there? I know that. Adam, have you any idea what SB1 is at this point? You said you were in Sacramento.
It's not been assigned to the committee yet. It has to go probably to 2, if not 3 committees in the Senate, and then a number of them on the Senate, but on the Assembly side. But there's rumors that Senator Kiko is going to completely revise it. It's just a rumor again, and there's rumors that there's lots of rumors. But what we have in fact before us, there's a lot of opposition growing up there.
To talk about the bonds for just a minute. The best we could do with the bonds was a BBB- rating, because this is considered a gaming facility. I mean, irrespective of our cash flow, the best we could do is a BBB-. So I would challenge anybody to come in and try to double the debt, go out into this market and match the interest rate that we got back then. It just isn't going to happen. So if we go down that path, the probability of finding finance in the market is slim to none. And I could almost guarantee that whomever goes down that path, in addition to the revenue streams coming off this track, they are going to ask for additional guarantees, and if that's from Del Mar, then they will ask for Del Mar to guarantee the bonds, and that means if the property can't pay for the bonds, then the people of Del Mar would end up on the hook for the bonds. So, and that's if they can get the bonds.
But to add to your point, Russ, obviously you and I were involved in this, and you took the lead on getting those bonds done when we did it 4 or 5 years ago now. The underwriting was very, very tight at that time, and horse racing was a whole lot better then than it is now. On a tax exempt basis versus today would be a taxable basis. And the part that people miss, which every time I explain it, people look at me like, really, is that the deal? This property cannot carry any more debt than it has today. And anybody that tells anyone else, oh yes it can, has not looked at the books. When you add in the fact that we're talking taxable bonds versus non-taxable bonds at a higher interest rate, when you're talking about horse racing that's not as strong as it is today as it was some years ago, it is impossible to put more debt on this property, which means either this property is going to be sold for virtually no money down and pay me later because it can't afford any payments now, or someone's going to have to write a $200 or $300 million check. And there are no buyers that can do that or would do that for a property that returns no cash on cash back to the person that wrote the check. I'm flabbergasted that we're having this discussion, because for people that are in the business, and around this table everyone here is in business and we all understand economics, there are no economics to support this deal. I think Adam called it the first time he heard about it voodoo economics, because there's no science and there's no math to underlie any of the assumptions, and yet we still have this discussion. I would hope that Sacramento under the new administration has a different tone in place, and this goes away and we can go back to the business of running this fairgrounds. There you go. Okay.